In this video, I'm going to talk about all these things in simple and easy way so that you better understand what is stock market and everything around it. Let's do it. Let's imagine a new tech company decides to expand its business. First, the company finds big investors and advertises itself to get sponsorship. Well, of course, the investors have some requirements that the company must meet to qualify. If the company's activities and financial performance made sense to them, they jump at the chance to invest and then sponsor the company's IPO, or initial public offering. This makes the company a publicly traded company. It means the company lists and issues stocks of itself on a public market where people can buy stocks of the company based on how much the business could be profitable in the future. Now, buying stocks means investors are owning a percentage of ownership in the company, and the investments provide the company with the cash flow and help the company to earn more money and grow and thrive. As a company becomes more successful, more and more people are willing to buy those stocks and take part to gain profits, which in this case, many good things happen. The demand for those stocks increases, the stock's price goes higher, and with it, the company's market value. And those who already own the stock hold on to it and hope for greater return. But in the stock market, there's always success and failure. If for some reasons behind the company's growth is not favorable, the reverse definitely happens. Investors become worried about the company loses value and the stock's price gets worthless. So what they do? They start to drop out of market before the stock potentially drops even further to minimize the losses. And obviously, a company appearing to lose value scares prospective buyers from investing in the company's stock. So as you can tell, less and less people are willing to buy those stocks. As demand for those stocks decreases, so does their price, which in turn leads to a decrease in company's stock value and company's market value, which this can leave some investors who already own the stock and hold onto it with big losses, unless they wait for the stock to recover and recoup their losses. This seesaw relationship of supply and demand, supply on one side of the seesaw and demand is on the other side, is constantly changing for some reasons. And I'm going to talk about the four literally most important reasons. Number one, news. Supply and demand is highly sensitive to the news of the moment. Positive news causes people to buy stocks like, positive news like an announcement of a new product. And also negative news causes people to sell stocks like, changes in leadership, like soon after the tragic death of Steve Jobs provoked a strong reflex, causing Apple shares to drop considerably. Number two, fundamental factors, such as determining the intrinsic value of a stock and its potential for long-term success. A lot of people who are not professionals lose money in stock market. And there's one important reason why. They don't look at the fundamental factors, which are really essentials. Number three, stories. Now, what most people look at when they want to buy a stock is stories. They really rely on some kind of stories around a certain stock and buy it and have unrealistic expectation of further growth. If you do so, you're definitely gonna lose money. You see, an exciting story makes a stock really attractive and more people want to buy the stock. And that increases the demand and the stock's price raises significantly above its intrinsic value. And that causes a bubble in the market. But this surge in prices is very short-lived. When people come to conclusion that the stock is overvalued, they start to sell the stock and the stock market bubble bursts and leaves so many investors shell-shocked. Number four, economic factors such as employment, a raise in wages, unemployment, a fall in wages, and inflation. You see, the more people are employed and receiving a steady paycheck, the more people there are to buy stocks and invest. And obviously, the opposite happens with unemployment and a fall in wages. And the same thing happens with inflation. High inflation rates erode the purchasing power. So inflation generally means, tighter credit and less demand. All these factors combine together and makes it very difficult to predict the stock market. That's the stock market. People buy and sell tiny pieces of companies based on how much the business could be profitable in the future. And that happens thousands of times a second all over the world. There are stock markets everywhere, but the New York Stock Exchange is the largest stock exchange in the world. And I really love the story behind it. It traces its origins back to the Bretton Woods Agreement on 7th May 1792, when 24 stockbrokers put on their top hats and got together under Button Tree on Wall Street in New York City. They got together to develop some standards around how stocks could be traded and establish said commission. Today, it's where shares in big companies like IBM, P&G, GE, ExxonMobil are traded. The NASDAQ is the second on the list of stock exchanges behind the New York Stock Exchange. It was founded in 1971. It was the first stock market in the United States to trade online. All the trading happens electronically, and it focuses more on technology stocks like Apple, Amazon, and Microsoft. Now, if you want to know how the stock market is doing, it's freaking important to know how both these exchanges are doing. That's where indexes come in. A stock index or stock market index measures the performance of a stock market. It takes a whole bunch of stock prices and calculates the average price number and gives you one clean number so that you have a better grasp of stock as a whole. So you can better prepare for buying stocks, investing in stocks, and selling your stocks. In other words, indexes are a mathematical average that quickly tells you how the stock market is doing. The S&P 500 gives you the average number of 500 largest companies on both exchanges. However, the Dow Jones is a lot more exclusive. It traces the 30 most important companies. The Dow and S&P 500 offer big picture view of the stock market in general and how those publicly traded companies are doing. Today, a lot of companies are publicly traded, but that wasn't always the case. All right, that's it for today's video. I hope it was helpful. I hope you enjoyed it. If you have any questions, feel free to ask me in the comment sections below. If you were interested in this video, you might be interested in this video as well. And if you made it so far, thank you so much for watching. I love you. If you want to see more videos like this one, subscribe to my channel. I'll see you in my next video. Bye-bye.